The Federal Reserve is likely to signal Wednesday that it may nudge up interest rates sooner than expected in response to sizzling economic growth and a spike in prices that has sparked inflation fears. The Fed and many private economists continue to think that higher prices are a temporary result of a pandemic-stifled economy suddenly free to go full throttle. But others warn policymakers not to underestimate the danger of a longer-lasting problem. The Fed is making a big mistake if they think they can look the other way with the price of goods and services jumping, said Chris Rupkey, chief economist at Fwdbonds, a financial market research firm in New York. This inflation looks as permanent as it is dangerous, he added, because higher prices have the ability to curb consumer purchases and shut the economy's spending right back down in a hurry. After decades of almost no inflation, the current surge has unsettled financial markets and spread alarm among some business and political leaders. Democrats in particular worry that Republicans will play on fears of runaway inflation to win control of Congress next year. Consumer prices jumped 5% in May from a year ago, the fastest pace since August 2008. Producers are paying more for supplies, and many workers in the wake of COVID-19 are holding out for better pay, raising the prospect of higher wages adding to inflationary pressures. This is the reality. We're dealing with inflation, said Diane Swonk, chief economist at Grant Thornton in Chicago. Most people haven't seen this kind of inflation, and it's startling. It's hot. Fed Chair Jerome H. Powell has insisted that the latest run-up in inflation is transitory. And to his point, prices for such items as used cars and lumber already seem to be coming down from their peak increases. But beyond specific products and sectors, what's fueling inflation overall is booming pent-up demand. Many consumers have lots of cash and savings to go with it. Others have benefited from massive federal spending and a reopening of economies after many months of pandemic restrictions. IHS Markit, a leading forecasting firm, predicts the U.S. economy will grow at a blistering annual rate of 11% in the current quarter, only slowing to a rapid 8.5% pace in the final 3 months of the year. On top of that, Swonk and other economists worry that a shortage of semiconductors, which has disrupted auto production, and other supply bottlenecks pushing up prices could last for more than a few months. With home prices soaring, rents could soon follow. And imports of China-made goods are costing more, too. There are just a lot of different things out there that are pushing our costs up and pushing prices up, and therefore inflation, said Gregory Hayes, chief executive at Raytheon Technologies and a leader at the Business Roundtable, an association of CEOs of major companies. In their March projections, most Fed officials saw inflation running at less than 2%.